Hey, Mark, it's great to have you on the show. Welcome.
Thank you so much for having me on Strategy Skills.
Okay, so we have a lot to discuss. It's been a big year for M&A. And according to Kim Posner, the head of investment bank at Goldman Sachs, she thinks it's going to be an even bigger year this year. So I want to get straight into it because we have a lot of exciting things to talk about. When the dust is settled and the $5 trillion odd of deals have been integrated, do you think shareholders are going to be happy?
So that's a good question. I'm not a soothsayer, so all I can talk about is what we've studied and what we've found, not just in the book, but in past studies that I've done. Let me start out by saying that this old statistic that you still see cited, that 70 to 90% of deals fail, we got to get rid of that. I don't know where that evidence ever came from. Even back when I was studying the deals of the 80s, and early 90s as a doctoral student at Columbia Business School, even then, the worst, it was 65-35, 65% negative market reactions, 35% positive. So, and it's gotten slightly better over time. And so I would say it's maybe 60-40. You could even say 50-50. But I mean, the old statistic that the vast majority of deals fail, we just got to get rid of that.
So if we extrapolate, it's possible it could be, again, 50-50.
Just based on, I would say, again, I'm not a soothsayer, but just based on the evidence, it's like a coin flip.
Okay, so before I go into my follow-up question, I read your book, The Synergy Solution, and I noticed the language you used is, you said less than 50% of M&A deals ultimately deliver their promised value. So more than 50% is delivering value, but not their promised value.
Oh, sure. And that gets to the heart of the challenge. That absolutely, yeah.
So based on what you've seen and best practice research, why do you think this happens?
So let me just square something you said about that they create. So we also have to say that mergers do create value at the sort of the macroeconomic level. When you add the gains to the sellers and the gains or losses to the buyers, it's a positive number. So we shouldn't have any sort of major policy decisions about it that somehow M&A is bad. It creates value overall. The issue is when does it and when does it not create value for the buyer or the acquirer?
Yes.
So that said, the question you asked, why do I think that less than 50% of deals fail to deliver value for the acquirer? Let me start at a very high level, and then we can get down into specific. But we start out with the presumption, number one, that capital is luxurious and it's expensive to touch. And there are smart things to do with capital, and there are less smart things to do with capital. And the second one, again, high level starting point, is that M&A is different. It's a different type of capital investment. You pay the full price up front before you even get a chance to touch the wheel. So that cost to capital clock and that capital starts ticking right on day one, whether or not you're ready to deliver. And number two, when you pay a premium, you're creating a brand new business performance problem that never existed before, and no one ever expected, or the target would have been selling at that price in the market. And so let me give you a simple example. I think this is important, and it sets the stage to which original question was. But imagine you're looking at a target, and I'm going to keep this simple. Imagine you're looking at a target that's trading in the market at $1 billion market value, equity market value. And it has, say, 40 million of net operating profit after tax, NOPAT, 40 million. And so if we capitalize that at a 10% cost of capital, we would say we had a current operations value. In other words, if performance never improved, it's worth about $400 million. So it's trading at $1 billion. So we have current operations value of $400 million. That means we have $600 million of expected growth or growth value. So if I go and I pay a typical 30% premium for that $1 billion company, or $300 million premium, what have I done? I've just tacked on $300 million to that growth value, because it doesn't exist yet. So I now have a company that's got $400 million of current operations value, but now $900 million of future growth value.
Which needs to be created.
Well, yeah, and you don't want to mix those up. You don't want to
Yes.
confuse synergies, which are if but for the deal. You don't want to confuse or mix up these synergies with the value that was already expected by investors.
I want to clarify something for the audience because I think the
Yeah.
point you're making is important here. You're saying that the premium is almost new business that doesn't exist yet.
Yeah. Yes, absolutely. Yeah.
So what you're referring to is that when you pay a premium,
Well,
depending
it's
on
not expected. Let's just say it's not expected.
When you pay a premium, the bigger the premium is, you've always got to manage the acquisition as the existing business and based on the value you expect to create, and then the new value you need to create to compensate for the premium you paid.
Yeah. Otherwise, think of it like an economic balance sheet. If I, pay that $300 million, and I'm really only going to get $200 million of value out of it, well,
Yes.
you got to keep that economic balance sheet balanced. So the acquirer loses $100 million of value.
Yes, it's interesting. I've spoken to many CEOs, and I don't think they look at it that way.
How do they look at it?
Because, well, my background is the resources, right?
Mm-hmm.
So if you're buying a copper company, there's not a lot of additional businesses you can create from copper besides selling more at a higher premium.
Oh, I see what you're getting at. Yeah. So it doesn't necessarily have to come from new business. It can come from cost reduction programs.
Okay.
So think of synergies can be, and again, I'm going to keep this at a high level, but it's either from cost reduction or revenue enhancements. And so there are plenty of deals where the deal gets paid for from cost reductions. But there again, I got to tell you, you don't want to mix up synergies from ongoing cost reduction programs that might be in place.
Yes.
You don't want to mix those up. So in sort of consulting terms, we often use the term, what's your base case?
Yes.
What are you already expected to do? So you have your trajectory of growth, and then you overlay the synergies on top of that. So base case and overlays.
So let's break down synergies for the audience here. What would be the big buckets of synergies?
Well, like I just said, it could be cost reduction. You don't need two world headquarters, for example.
Yes.
Cost reductions on one hand, how do you make the businesses more efficient? Is there, again, at a high level, are there scale opportunities from a bigger business? And then on the revenue side, what are you doing for customers? How are you serving customers in a way you couldn't serve them before on either side, and in ways that competitors can't easily replicate?
I'm familiar with the list, and I think the audience knows the list.
Yeah.
I think the question I'm trying to get at here is, if most CEOs know this is not new information. So why are so many not succeeding at it?
So that's a great question. So I think there are multiple reasons, and they start at the very beginning. I'll just keep this sort of simple. If the strategy wasn't clear, and we can talk more about what we mean by strategy, because I think it's strategy and culture and transparency are those words that mean different things to different people. But if the strategy wasn't clear, that is how you were going to create additional value, that's not clear. And then you didn't do the proper diligence to test those presumptions, either from a cost perspective or a revenue perspective in the market. And so then you overpay for the deal. So now you're kind of behind 7-0 in the first inning.
Yes.
And so then you announce the deal to markets, you get a negative market reaction. And then you don't do the kind of planning you need to do sign to close. So since you overpaid, you're assigning nonsensical synergy targets to work streams.
Yes.
They're supposed to come back with those synergy plans and milestones and early indicators and all those. And employees are unsure of their future, their roles and their future in the new organization. And then those work streams don't do the planning they need to do to develop work plans to get to some sort of end state vision for each function or business. And then you get to close and people are vibrating in place. And then we'll ultimately blame it all on, we didn't manage the cultures right.
Okay, that's a good overview. Just for the audience, we using the word work streams, we're referring to work streams, activities of work to see through the integration after the acquisition, common consulting term. So I'm just mentioning that for the audience.
It's a great point. Let me put it in context. Think of the structure you should launch immediately after announcement. And this is where a lot of companies waste a lot of time after announcement, just putting together their integration,
Yes.
their IMO or their integration management office. And think of the structure of an IMO. It's both a top-down and bottom-up structure. So at the top, you have the steering committee, you have the actual integration management office, which are pretty senior leaders from both sides who know the businesses and have gravitas. And at the bottom of the structure, you have the work streams: HR, marketing,
Yes.
finance, tax, a number of work streams. And then there are cross-functional work streams that cut across the functions, like organizational design, synergy planning, the employee experience, and day one readiness. So yeah, when we talk about work streams, we're talking about all those work streams or streams of work, whether it's in the functions or across the functions, that are going to be assigned targets.
Excellent. So coming back to your answer, you mentioned that things can go wrong if the strategy is not correct, if you overpay, pay a premium, if you mismanage the announcement, and then if you manage the integration incorrectly. So you've categorized those 4 areas where things could potentially go wrong. Is that right?
Well, and I would add to that the diligence part.
The due diligence. Okay.
That's right, because diligence is often viewed as something to make acquirers comfortable or reach a go or no-go decision, when in fact diligence is about, you're testing presumptions from strategy, but the outcome of diligence is inputs to the valuation model or testing the assumptions in the valuation model. And the other output of diligence is your early integration roadmap. I mean,
Yes.
once a deal goes live, that's when things start going fast. There's thousands of non-routine decisions that have to get made in a very short period of time. And so, what we'll probably talk about later is that post-merger or post-close is the wrong time to do pre-merger planning.
When is the best time to do it?
When you're developing your M&A strategy.
Okay, so there's a lot of interesting questions. I'm going to unpack each of them, Mark, so the audience can follow, okay?
Sure.
Because what you're saying makes a lot of sense for me, but I want to make sure the audience gets the right kind of information so they can do things differently on Monday morning. So let's start with the first thing. I was speaking to the CFO of one of the largest automotive companies in the world. And every single company in that sector is doing deals in electric vehicles and AI. Now, if everyone's doing deals and everyone's paying a premium, someone has to fail because not everyone can grow. Someone has to be losing market share. So the discussion I had with him is that every company in that sector is paying some premium to get into electric vehicles or develop the capabilities for EV, and the same for AI. So everyone's paying a premium, but surely not everyone can grow their market share. Now, in this kind of market where it seems that everyone's doing deals, how do you know, what are some of the things you've seen smart CEOs do, or the advice you give them to make sure the strategy is sound? Because that was the first block you listed.
Yeah, this is a big one, maybe the biggest, actually. And, I started doing this work more than 20 years ago. And one of the things that we'd often see in consultants' notes was, how did this deal ever get there? Like, why are they looking at this? Yes. And so the common problem, and you definitely see it during merger waves, is that companies are reactives. I mean, let's start at the beginning. How do you get a merger wave? Well, or even as an economist might look at it, a big concentration of M&A activity. It's that companies are starting to do things they weren't doing before.
So it's fear of missing out.
Well, it's reacting. So just like the story you told, or what's even more common today, when there's been an increase in the number of big deals, a big deal gets announced in the industry, all the bankers go after the other companies in the industry, and they say you have to act pretty quickly. You're going to be left without a dancing partner. And so that's what reactors do, is they react, versus being what we call in the book a prepared acquirer, or prepared always-on acquirer. You should, on a regular basis, look at the deals that your competitors are doing, because companies signal their strategic intent through M&A. And there are lots of places you can do deals. Not every business you have has earned the right to do M&A. So right at the very beginning, what's the role that M&A is going to play in our growth? Is it 10%, 20%, 30%? What's the role of M&A, and what are the most important deals that we need to pursue over the next 12 to 18 months? The most important pathways. And then along those pathways, what are the most important deals? So it should be pretty difficult for someone to bring you a deal you haven't thought about before you've prioritized it. And other deals get done. If you look at the most active acquirers, they may only close 10 to 20% of the deals on their watch list.
Yes, because they have an intent of what they want to do.
They know what they want, and I've been through this sort of process many times, and it's really tough because you have to make choices. Nobody likes to give up choices, and that's what M&A strategy ultimately is about. To become prepared, you have to make choices about the assets or sets of assets that are most important to you, that you believe are the most important. And you can start doing that diligence right in your M&A strategy phase. If you think there's new offerings you're bringing in the market, you can test that. All the answers are in the market. And so that, at a high level, that's where M&A strategy starts, which is what's the most important. What are the most important assets we need? We're either going to exploit capabilities or we're going to close capability gaps.
So if I'm hearing you correctly, the way you're thinking this through is that when you go in to advise a client and you look at a deal they want to do, the first question you ask is, why are they doing the deal? Or are they doing this deal because they are following someone in their sector?
Yeah, I mean, the simplest question is why didn't you look at this 6 months ago when the market was 20% low?
Yes. Okay, that's very good. I like that. So as you said, that's the biggest part, because if you do the wrong deal, it doesn't matter how you close it, it's not going to create the value you intended for it to create.
Well, all those other things have to go right. I mean,
yes.
When you react to a deal, think of it like this. I'll put it in sort of academic terms because it's pretty important. Reactors are playing this constant game of not to lose, right? The deal comes across the table. They put together a team. They got 2 weeks to 3 weeks to look at something, and then it's a go or no go decision. But in the process of doing that, they've increased the odds of false. So they're trying to avoid false positives. But what they've done is they've jacked up the risk of false negative. That is ruling out a universe of other opportunities that may have been better had they considered it. And one of the things we find in an early stages of an M&A strategy exercise, a couple of weeks in, is you'll find CEOs or head of corporate development will say, I didn't realize there were so many companies out there. And they may have looked at some of these, but it's just the realization that there's a universe of opportunities, which means you have choices to make. It could be size. I mean, at the highest level, it's size and maybe geography. And then it becomes more and more fine-grained issues. The longer that the targets stay on your list, you'll be developing profiles as you go, because you won't know all the things you need to know when you start one of these processes. But as you go, you'll be able to dig deeper into those companies that remain. And so at the end, you have a watch list with pretty detailed profiles of the companies that are most important to you.
Now, but this presupposes the CEO, the board, and whichever team is running this in the company has taken the time to create this deal flow structure.
Mm-hmm. Yes.
And obviously that's an ideal situation, but for many companies, they are reactive. What do they do if they're in a reactive position where they haven't done this, but all the good deals are being taken off the table? Do they step back and reassess things, or do they say, okay, we know what we want to do, let's react?
Well, I think you're almost giving the answer to what you see the struggle that's in your question. If you've trapped yourself into being a reactor, it's very difficult not to react.
Yes.
If you haven't decided the most important deals that you want to pursue over the next year or two, and you're not regularly refreshing that pipeline and reevaluating as a competitor may do something on your watch list, then you've trapped yourself into reacting. And then it takes a lot of discipline to take that step back.
So coming back to due diligence, we spoke about strategy. There was a good discussion. Due diligence. You made a point earlier where you said the post-merger planning should be done in the due diligence stage. Did I hear you correctly?
Oh, absolutely. Yeah.
You want to elaborate on that?
Sure. So let's take it from a cost perspective. So think of in the diligence stage, you're either developing the inputs to your valuation model, or you're testing the assumptions that someone's put into that model. And the way I put it is, and we do this at the Synergy Solution,
Sure.
the assumptions that go into a valuation model, until you pay it, they're just assumptions. But once you
Yes.
pay it, they're promises. Or once you announce it, they're promises. And so let's just, on the cost side, you have to think about what are the synergies, what are the dis-synergies. So for example, let's say you think you could save X million dollars by closing a world headquarters. You may need to, that's great, that'd be a cost savings, but there may be one-time cost to do it. And you may have to take on additional floors, let's say in your current world headquarters, that's more expensive. So, it's things like that. And so what would that roadmap look like? How fast is that going to get done? Is it going to get done in the first 6 months, first year? When are you going to incur those one-time costs? You can start doing a roadmap for these major cost reduction initiatives. So what are the quick ones that you can get? What are the ones that are going to have to go in stages? Are there going to be interdependencies across some of these cost reduction work streams? What are the one-time costs? And what are the areas that are going to require the most attention? Like if you think there's significant synergies from consolidating your ERP systems, what are the one-time costs to do it? How long is it going to take? What are the interdependencies along the way? So that should be done. That early integration roadmap should be done. And think of how important this is. That should really be done before you announce the deal, because when you announce the deal, investors are going to give you a forecast of what they think.
Yes, immediately.
And if you don't have a plan, if you don't project the credibility of having a plan in place so that you can kick off the sign to close planning immediately after announcement day. And remember, this is moving really quickly. 3 weeks before you're doing this diligence, you're going to announce it. You're in the sign to close planning the next day. So, without some sort of early integration planning or an early integration roadmap, you're basically starting from scratch after announcement.
But let's dig into this a little bit deeper, right? So my experience advising companies on strategy, M&A, and so on, and even talking to executives today, most of them don't have the luxury of doing it. They feel they're under pressure, and even though they want to do the post-merger planning during the due diligence, they never really get to it. So in those situations, it's hard to comment on how to manage it, but in those situations, in your research, have you seen that companies who do the post-merger planning perform better?
Well, think of it this way. If you're not doing that, how are you putting numbers in your valuation model? I mean, if you don't know what those numbers represent or the activities that are going to drive those numbers, what are you putting in your valuation model?
Let's unpack it, because maybe you're using the terminology differently. Because I think one of the things for the audience is we're going to have people in the corporate environment who are listening to this, and they use the word post-merger planning different from consultants like me and yourself. Okay. So when you refer to post-merger planning, that's the entire implementation to realize the benefits.
That's correct. I agree with that.
Okay, but I agree with everything you're saying, but I want to make sure the audience understands where we're coming from, because people in corporate don't speak the language we speak. So if you're pushing through a deal in 2 to 3 weeks, it's sometimes hard to get the detailed numbers. So sometimes you have to present some kind of top-down version of this, is what you're saying.
Well, let's try to keep terms straight. So what I'm thinking of, and I've done this, hundreds of times in the diligence process, and this is before you've announced the deal. I should have a pretty good idea of what that roadmap of performance improvements look like. What's going to happen in the first 3 months? What's going to happen in the first 6 months? The first 9 months? If you're consolidating ERP systems, that could take as long as 18 months. But I have to have some idea of what's coming first.
Okay, so this is the important point that I make. So when I'm using top-down, you're using the word some idea of what is coming first.
So we may be using top-down and bottom-up differently. Yes. Top-down is what you typically get in a valuation that's coming from the outside. You get we see it over and over again. It's the magic 10% cost reduction. And where that originally came from is, if you think that the addressable cost base is maybe a third of your cost base, and you can save a third of that, a third of a third is roughly 10%. So The top down are these sort of function by function numbers that somehow
Yes.
somebody comes up with outside
The
the
sort
company.
of scale of the benefit.
Well, yeah, and they can come from benchmarks as well. You can compare the your cost structure versus top performing firms in the industry, the top 75% or top 50%. And you can do these, but those are top down numbers. Bottom up is when you have access to the data room and you can look at these companies function by function. And then you build up a bottom up model from the actual numbers. And you may get to that same 10% that was driven top down,
Yes.
but you'd be surprised at how different the numbers are by function when you're building up a bottom up model. And one of the things that we believe is very important in diligence is that you compare those top down assumptions to your bottom up numbers by function.
Well, that's the point I was trying to drive at, is that, so you're
So you
saying
can
in the
see
due
what
diligence, it has to be both the top down and bottom up needs to be done in that phase.
That's what we do.
Okay, makes sense. Perfect. So I want the audience to understand that so that they can think through how they roll this out in Monday morning. So moving to the announcement of the deal, what are the best practices for that stage?
So that's a big question. And this is what I think is one of the crown jewels in our book. Think of announcement day as serving three important functions.
Yes.
Preparing for it is your last stop in diligence. So preparing for announcement day, you're trying to answer the question, am I going to give investors reasons to buy my shares or sell my shares, right? So think of it as the last stop in diligence. Second is your investor presentation, your conference calls, any press releases you do, any road shows you do. You're creating communications that are fodder for all stakeholders. So customers are listening to you, regulators are listening to you, suppliers, obviously investors, employees are listening to you. So think of announcement day as the sort of the zenith of attention you're going to get on a significant deal that could really affect the share price. As it's fodder for everyone else's diligence. And the third, and this is very important because culture is so important in M&A. We believe culture starts an announcement. Just the way the investor reactions set a tone that the organization is going to have to live with, you're setting a tone for employees. And so the words that you say, they're listening to, because think of it, you're bumping them down their hierarchy of needs.
Yes.
They're minding their own business. They're all set. They have they have sort of a career in mind and a future in mind, and you've bumped them down from self-actualizing down to safety needs. They're worried, do they have a job? Right, benefits going to change, and you have to address those concerns very, very early on. And if you don't have answers, you have to time box it. So if you say we're announcing the new, let's just say, organizational structure in 4 weeks, you got to do it in 4 weeks. If you say we'll have answers to your benefits questions, next date, have it on next day. As one of our colleagues says, is you're borrowing trust you haven't yet earned, and that starts on announcement day.
Okay, so in terms of the rollout of the announcement, right? You've mentioned the different stakeholders, and you've rightly talked about the anxiousness that employees of the acquired company or the companies being merged will feel. Is it a sequence in terms of who you reach out to first that works best?
I wouldn't say there's a sequence per se, and we can talk about like the actual questions you're trying to answer, especially for investors. But I would say that number one, you've got to formally define and document the deal thesis and key messages to all stakeholders. You have to define those stakeholders. You've got to collaborate with your external communications and your communications channel. And you would have to establish timing and presence of senior executives who people want to hear from.
Yes, that makes sense. And in terms of, let's assume the deal's done, everything's closed, regulatory approvals, shareholder approvals, all done. What are the best practices for the actual integration process?
Well, I'll go back to what I said earlier that, and sorry, hopefully we keep our terms straight, but when I think of post-merger, I think post-close, just what you're saying. If you've done the planning right, if you used your time in diligence and the sign to close period, which can be as short as a couple of months to 6 months, or more if there are regulatory issues. If you've done that work right, then post-close or post the actual merger should be a period of transitions. It's not like you show up at close and start executing.
Yes.
It really should be a period of transitions. And in the synergy solution, we go over 5 major transitions. The first one is that IMO structure, that integration management office that you created, this temporary living, breathing structure. It has to go away. So these work streams that sit under it have to graduate. So they don't have to go to any more IMO meetings. So you have to have a graduation process of how you leave that IMO structure.
For the audience, just to clarify for the audience, graduate to what?
Oh, business as usual.
Okay, that's very important, right? Because we're using consulting terms, not everyone has a consulting background.
Yes, so graduating to business as usual, you're no longer part of the IMO structure. You don't have to go to any IMO meetings. That the targets are now built into just ongoing executive plans and their own goals. So that's one major transition. The second major transition is the work you've done in organizational design and picking the leaders at maybe down to the second or third level that you'll announce right around close, especially your L2 and L3. That organizational design work now has to go through the organization. So now you have to go through talent selection and workforce transition.
Okay, so that means appoint the people to run things.
Well, all those procedures and the documentation that all functions and businesses will follow has to flow through. So you're not getting yourself into any trouble. You have to pay attention to DEI goals, and et cetera. So, and then the workforce transition. So people may be moving into new roles. You have to make sure they're supported. Do they have the training programs in place to do that new role? Basically, people have to know very quickly, are they going to be affected or not? And if they're going to be affected, how do they be effective in those new roles? So that's where the knowledge transfer of people that may be leaving, we have to make sure we transfer those knowledge to people that may be stepping into that role or a new role. So that's a second major transition. The third major transition is all the planning you did around synergies, the individual initiatives. And I should tell you that it's usually 10 to 20 major initiatives drive the vast majority of the synergies. But those those basic initiatives or those major initiatives have to break down to projects, individual projects and milestones. So all the work you did pre-close now has to transition into tracking and reporting. So yes. How are we gonna track those? What are the major milestones? And then that's where you introduce those early indicators. So for example, this is something I've been involved with in a couple of deals in the last few years, a major insourcing initiative where they had outsourced production. One was a cosmetics company where they had outsourced fragrance production. One was a toy company where the target had outsourced its toy production. And those are big initiatives. You got to hire designers. You have to order new equipment. You may have to redesign your facilities. You have to sunset the old outsourcing agreements. And so you want to make sure you have early indicators so that you know you're on track. You don't want to just miss a milestone. There should be early indicators. Whether are you hiring people? How have you ordered the new machines?
Yes.
That sort of things. And so that's number 3. The fourth big one for us is that if you think about revenue synergies, a lot of that work is going on in the clean rooms because it's competitively sensitive information.
Yes.
So you leave the clean room. Now you have to go into the real customer experience and growth. And that's where you're putting in place your new go-to-market strategy. I mean, if you're cross-selling, if you're bringing new offers, new bundled offers to market through your new combined sales force, that's a major transition. And then the fifth one that we write about is all the work you've done on the employee experience, anticipating changes that are going to happen for employees. Now it's the actual change management and building the new culture, how work gets done. So I guess to put a sort of bow around it, post-close execution, or after the deal closes, it really should be a period of transition from the planning you did to these, in our view, these 5 major transitions.
Yeah, they make a lot of sense. They seem practical. That's how I've seen it work in the real world. So let's step back out and talk through some what I call quirks in the system, right?
Sure.
What happens in a situation where you're trying to close a deal in something like 3 weeks and you don't have the time to do everything using the best practice you laid out? How have you seen those things play out? What advice would you give executives in that situation?
Well, it's a very good question. It's a very practical question. In essence, you may end up doing, I'm saying this a little tongue in cheek, but it's what we call it. You may end up having to do post-deal diligence. The work that you would have done. There's no short. Yeah, I mean, there's no shortcuts to this. I mean, you're always testing issues, in the market, with your outreach with customers and what they want and their unmet needs. You're always doing that anyway. But often you're going to have to do the work that you should have done pre-close. You'd have to do it post-close. There's no shortcuts.
Yes. And I want to come back to a discussion we were having earlier, because there's an important point I wanted to make. We're talking about bottom up and top down, right?
Right.
And what I've seen in my experience is that most companies are not really good at the bottom up work. So they're pretty good at the top down work, but they normally need to bring in consultants to advise them on the bottom up work. Is that what you've also seen?
If they haven't done it before, sure.
Yes.
Yeah. I mean, if there are plenty of experienced acquirers that have their own integration offices and heads of integration planning. So if they haven't done a significant transaction before, then consultants can be very helpful, because we do this over and over again. So we have the structure and we have the tools that can accelerate. We always talk about accelerating synergies and accelerating the planning. So, we have the organizational visualizer tools. We have the large program management tools, and Echo's contract management tools. So, we bring a lot of tools that are very helpful. So that it's generally, consultants can be very helpful and this is what we often hear, well, we haven't done anything this big before.
Yes.
And so, in some of these big deals, and we've counted them. I mean, there's as many as 10,000 non-routine decisions that have to get made. Everything as large as, which ERP system are you going to stay with, or which world headquarters are you going to use, right down to, what's the quality of the coffee? Someone's got to make that decision somewhere.
Yes. So let's just step in this direction a little bit. Now, we're both going to be maybe a little bit biased here, and because we'll have a certain answer here. But what role would consultants play that would add value versus the capabilities of an organization? I'm not debating the value we bring, but I want to lay it out for the audience so they understand, because I think some people may have experience working with consultants, others may have done it only from a corporate side. But I want to talk through the role consultants would play here. Well,
my view is that we're advisors. So we've seen deal after deal after deal after deal, whether it's, and you're talking about post-close management or post-merger.
It could be any side of it. It could be the strategy side, due diligence.
So we've done this before, and the older partners like myself, I'm going to turn 60 next month. We've been in these situations from M&A strategy and diligence and valuation and announcement day, pre-close planning and post-close execution. We've done it many times. So I feel, and I'll use the word feel, like in my gut, what senior executives who haven't done something this big before, they'll often ask the question, so what have you seen in your experience? Yes. What have you seen the best ways to do this? And so we're, not only are we bringing a structure and a process and tools, but we're also helping them make the big decisions they need to make early on, so that the teams aren't fighting it out. You don't have the two IT teams fighting out which ERP system that they should go with for 6 months, and they're not fighting over templates and that kind of thing. So, but we're bringing them a level of comfort that helps them along the way.
Yeah, that makes sense, because I remember that one of the terminology we used to use is when an executive asks us a question, we would say what we typically find, WWTF. So it's a common way of bringing past knowledge in. Listing out the best practices, and you've done a great job of talking me through how Deloitte manages this. Assuming now that every company can learn from the best practices laid out in your book and your work and so on, is it helpful for them to have this permanent structure in place, to be vetting deals, to have a dedicated deal team, to have a dedicated due diligence team and so on in place if they see a pipeline of deals coming down the line?
You're asking a pretty broad question. And the way I'll answer it is, if you think you're going to be very active, well, I would put it simply as you need to make sure you have the right people doing what they need to do at each stage of the process.
If you're going to be very active.
Oh, or even if you're going to do something significant. You know what? I'll start out at the beginning. One of the simple things I know your question is about should they have dedicated teams and that sort of thing. I start out with M&A strategy process just to
yes.
Sometimes it's in the pitch, sometimes it's in the execution. I say, what are the 20 largest deals you might consider doing? What are the 20 biggest deals that a banker might bring you that you might consider doing in your business, or maybe it's an adjacency? And I say, I can tell you right now, if you made the big choices, probably only 3 to 5 of those are going to be deals you should even be looking at. So, do you need a dedicated team to do that? Not necessarily, but you have to know what it is that you want and how you're going to create value. So whatever you need to do to do that. Now, when you get to diligence, you're going to want to make sure you have the teams that know how to do bottom-up cost synergy diligence, or know how to do commercial diligence in the market, testing presumptions around the revenue line. So when you call it a dedicated team or people know what they're doing.
Circling back, right? You spoke about what makes M&A a different kind of investment. Why do you think CEOs and boards are deploying capital through M&A? What's driving M&A at the moment?
Well, I'll go back to M&A strategy, and our starting point is you look at the growth value that's in your share price, you look at your organic trajectory, you look at your aspirations, and you see where the gaps are. And so M&A can be one answer to closing those gaps.
What you've laid out is the rational, logical thought process Deloitte and yourself uses to determine if M&A is the right fit for a company to meet its growth aspirations. So you've answered that part, but the question I was asking is, what has driven this boom in M&A?
Oh, well, one of the things we know is that M&A is correlated with rising stock markets. Over the last 40 years, what drives it? Like I said, I'm not a soothsayer, but M&A happens to be correlated with rising markets. So, and I think there's a reason for it, because even if you make a mistake, if you don't go back and industry adjust or peer adjust
yes.
returns, we talk about relative total shareholder return, or RTSRs. Those are peer adjusted. Your stock price will likely go up from that point, even if your industry adjusted returns are poor. So,
yes.
it's rising stock markets bring optimism. And especially if a significant amount of the purchase price is with stock, it means sellers are willing to take your stock.
Am I correct in then saying the optimism of the market is sometimes masking a bad M&A deal?
In what way?
If you have a booming stock market whereby for some reason the market's just going up and up, sometimes there's an incentive to do a deal because of the enthusiasm in the market. The board and the CEO thinks that the market is going to mark up this deal and the share price is going to go up anyway.
It could. I mean, think about why, one of our major findings, we should talk about the findings a little bit in our study, because we did a 24-year study.
Yeah, let's do that. Actually, that's a good point.
But just to maybe segue into it, one of the things that had been found, there's a whole literature on it, that stock deals underperform cash deals. And so, you think about what's the signal that a stock deal sends? Well, maybe we're overvalued. When's the best time to issue stock? When you're overvalued. And the other signal it sends is, if the deal was so good, why are we willing to share the benefits that you wouldn't be sharing in a cash deal? So just going back to your question about, do I think it's optimism? Yeah, it's definitely optimism.
Is this finding across all markets and all geographic markets and all industry segments, or is it clustered?
So we studied, there's a whole literature on this that goes back 20 plus years in the academic literature. But we looked at, just to keep some bounds around things, we looked at only U.S. Both the acquirer and the target had to trade on a U.S. stock exchange.
Okay.
So that's what we looked at. We also looked at the deal had to be at least 10% the size of the buyer, so that it had the chance of having some material impact on the share price. And they couldn't have done another major deal over the course of a year. So you can imagine that brings it down, but it's still a sample. It's still a sample.
Yes, and it's still significant. So.
Oh yeah, we did. We had over 1,200 deals, over $5 trillion of deals, over $1 trillion of premiums over 24 years. So we covered 3 major merger waves over that time.
And what were the other insights from the book? Sorry, I didn't mean to interrupt you.
Well, yeah, no, these are, and we bring this out right up front in the first chapter, and it is one of the themes of the book, and that is, again, consistent with prior literature. Acquirers on average, because whenever we talk about M&A studies, it's always on average. Acquirers on average underperform their industry peers by a bit. About 60% of deals are met with negative market reactions and 40% with positive market reactions. But that's not really the story. That's kind of like, okay, so what does that mean? So we start to de-average. And so what we did is we divided companies that based on their market reaction, we divided them into 2 portfolios. We had a positive reaction portfolio and a negative reaction portfolio, because we still hear CEOs and market observers say things like, well, stock market reactions don't matter, put it simply. And in fact, they really do. And so when we look at the positive reaction portfolio, we track it out over a year, and we went beyond that. But once you start to go out after a year, you get noise, could be other things. But the returns to the positive reaction portfolio are still strongly positive, and the returns to the negative reaction portfolio are still strongly negative. So market reactions matter, but even that's not really the story, because even that's pretty well accepted in the literature now. And that's that's actually one of the important parts of our study. Is there's nothing radically like, oh my God, you found something that nobody thought. But the next part is what's really important, and that is those positive reaction deals that stay positive. We call them persistently positive deals. They do great, and the negative reaction deals that stay negative, that sort of confirm those negative expectations, they do really badly. And the spread of returns between the persistently positive group and the persistently negative group is 60 percentage points. It's huge.
That's a significant difference.
It's enormous, and that's how we start the book, because what you want to walk away from that, I would think most people would agree, it's better to start with a positive market reaction than a negative. Now that doesn't mean that some of the negatives don't turn around or some of the positives don't turn around, but I'll tell you this: 2/3 of deals that start negative stay negative. And if and for stock deals, it's almost 3 out of 4 that stay negative. So while a positive reaction is no guarantee of success, a negative reaction is very tough to turn around. And so if you come away from it, now I should say, I've done this sort of study before. I had a cover story in 2002 Business Week magazine on the 90s deals. We found the same pattern before, but I never connected it to the process. And so if you think about it, if you want a positive market reaction on announcement day, think of all the work that you would need to have in place to get there. And also so that you can kick off integration planning efforts right after announcement day so that you can deliver.
So I have a follow-up question here. This is very interesting. You mentioned that the deals that remain positive and remain negative for a period of 1 year, so you followed it from 1 year after the deal. And then you mentioned that after 1 year, there's a lot of noise and other things happening that could cause influences there. But a lot of the post-merger integration work after the deal closed, normally that takes more than a year to see through. So have you looked what happens in 2 and 3 years?
Well, in my first book that came out 25 years ago, which was The Synergy Trap, we went out 4 years, and it was very consistent when you went on in time. In this particular study, in the Synergy Solution, we went out a couple of years, and about 80%, I can't remember exactly whether it's which one was sort of like 83% or 75%, but let's just say roughly 80% of deals in either direction were still positive or negative 2 years out. And so, the other thing, think of it like this. Yes, the actual delivery may be in the future, but that initial investor presentation and that initial reaction is a forecast of the future. So investors and other stakeholders are looking for information. We
Yes.
call it, from an employee perspective, it's sort of, you want to calm employees and then spark them to see what this combination could look like, and then inspire them. Ultimately, we call it calm, spark, inspire, but inspire them to see their futures with the company. From an investor perspective, it's very much inspire, spark, and calm. You inspire them with that initial investor presentation, then you spark them with starting to show results and describing where these results are going to come from. And then comes the calm of actually delivering on those results.
I just want to confirm something so the audience is following us here, because it's an interesting discussion. When you say the market perception is negative or positive, you're referring to the share price.
That's correct. Yeah.
So in other words, what you're saying is that the market's pretty good at judging the value of a deal.
On average, as a very well-known finance professor finally admitted about going on 20 years ago, I think we have to accept that the market reaction, and we quote this in the book, is a fairly reliable indicator of how deals will work out.
Yeah, because you see it so often. In fact, I saw it the other day where some executive was saying, well, the market reaction is not good, but we believe this will work. Now, I don't know their exact plan, but what you're saying from your finding is the market reaction is a pretty good indicator historically of knowing if a deal is going to add the promised shareholder value.
That's right. And if you have a negative reaction, like I said, some of these turn around.
Yes,
about a third on average turn around. That means you've got work to do, which means you got to get on the road. You have to explain this deal to investors. And we've had clients that start with a negative market reaction and they go on the road and they start explaining where the value is in the deal.
Yes. And basically, it's, as you mentioned earlier, it's a process of educating the different stakeholders.
Yeah, no, that's exactly right. Think of it like this. We say, what are the tests of a good investor presentation? The simplest one is, am I giving investors something they can track, they can monitor over time? So going to market with one big fat, $2 billion of cost synergies, nobody can track that.
Yeah.
So you've got to break it down into where, if you look at and we outlined several of these in the book, look at the level of detail that successful companies give. They're giving investors something they can track where the major sources of synergies are coming from. There are a few things we go through, but the other one I'd say is and you'd be surprised how many of these big deals, if you actually capitalize the synergies that they're talking about, if they even give a timetable, they don't add up to the premium. There's one that we write about in the book, which is patterned off a real company. We've disguised the numbers, but they go public. It's a $10 billion premium. They announce $500 million of synergies. They don't say whether they're coming from cost or revenue. There's no timetable from when that's going to happen. But let's just say it was going to start. It was going to start immediately. If you just capitalize the cost synergy number, or the synergy number, it doesn't get you to the 10 billion.
So this is a very important point, because oftentimes when people think about M&A and so on, we focus quite heavily on whether the management team and their consultants and bankers and so on has perfectly calculated the synergy value, the benefits of the deal, and so on. But an important point you're bringing up here is that it's important that enough information is given to the people who are going to vote on the deal in the market, basically the investors. And if you don't share enough information for them to make the correct assessment, they can vote the deal down. When I say vote the deal down, I mean lower the share price, purely because they don't know enough about the value that's supposedly going to be created.
Yeah, that's exactly right. Think of this as a classic asymmetric information problem. Management knows more about their plans than investors do.
Yes.
So they're reading their signals. Does that team have a plan? And you go back to the $10 billion premium with $500 million of synergies. Just capitalize that $500 million at 10%. That's $5 billion. How much do you think the share price went down for that acquire right on announcement? About $5 billion. difference between the capitalized value of the synergies and the premium.
And yeah, it's just because they mismanaged the communication.
Yeah, that was pretty bad.
Okay, so
and investors, think of it like this: they see deals every day. They've been, investors. If you think about it as a market, they do this for a living. So, the one thing you definitely don't want to do is go public with a large premium and a nonsensical synergy number that doesn't get you back to the premium. That's the no-brainer one. Then you wonder how those get out of boardrooms. But the other one is to the next part. Let's just say that economics seem to be there. Are you giving them something they can track over time, so that you can actually report? Because look, some of your some work streams or some sources of synergy are going to do better than you thought, and some are going to be less. But you want to be able to make sure that investors have something to track. And definitely don't go to market with one big fat synergy number. Investors.
Yeah, I mean, just for the audience, I remember using this example once with a client. Is that imagine if you're familiar with the reality TV show American Idol, Mark?
Sure, of course.
So you have the executive team that's doing a deal. As an analogy, they are the person singing. Now, the equivalent of this, of mismanaging the communication, is you go out on stage and you tell the audience that's voting is, look, trust me, I can sing, so vote. But it's not enough to tell them to trust me. You've got to show them that you can do it, right?
Yeah, that's right. Or the economic balance sheet takes over. They're going to make an assessment based on what you told them. You just read the investor presentation, and you've either given them enough information they say that sounds sensible. Now, if you're an experienced acquirer, then you have an advantage, because you've promised things before and you've delivered. It's different if you haven't if this is the biggest deal you've ever done. You're deviating from your business model, so you have to explain it even more carefully.
Yes, and I think if I'm an executive or even a consultant listening to this, you've perfectly articulated the importance of having a robust investor relations strategy in place. That's
right. And then following up on that over time, so that you're able to report the results over time. That's how you calm the markets. That's how you calm investors.
Yes, because you don't want them to wonder what happened a month after the promise you made. Because, as you say very well in the work, is that everything's a promise.
Once you pay for it,
everything is a promise. But now you've got to deliver on the promise, and you've got to keep them updated. You can't simply disappear for 6 months and let the market wonder what's happening.
That's absolutely correct.
Mark, thank you so much. That was a fantastic discussion. I hope you enjoyed it as much as I did.
I did. And if I could just close with one major takeaway comment, which is, think of M&A as an experience. It's an end-to-end connected experience. And if you think of M&A that way from the beginning, you greatly improve your chances of success.
I like that. And also, it's interesting the way you've broken it down and those findings. And, one of the things that stands out in this discussion is that it's so important to keep the stakeholders aligned as often as possible, so there are no surprises.
That's right.
And that's maybe the biggest takeout here, is that when we think about M&A, we always think about deal teams, the CEO executing the deal, getting the buyer on the side, and so on. But you've got to keep the people who invested in your business on board throughout, so they're not forced to make decisions that are not based on the right data.
Oh, that's right. And I would add to that, keeping your employees informed and your customers informed.
Yes. Absolutely. Mark, thank you so much. I thoroughly enjoyed that. I'm sure we're going to have you on the show at some point in the future.
That's great.
We'll keep you in touch in terms of how things are going to work. But I totally enjoyed speaking to you. I think our audience is going to like your book.
Well, that's great.
They'll love your book.
Thank you very much for promoting the synergy solution. And I enjoyed this very much.
Take care, Mark. Have a great day.
Thanks so much. Bye-bye.